Well, you're talking to the old retired man now of the outfit, and I just want to catch you up with a little bit of philosophy about the on and the off market. Now, basically, most of you realise that my focus over the last few years has been buying investments off market because we want stability and predictability. So one of the things that makes them undesirable to some people is their illiquidity. In other words, it's very difficult to sell the asset if there's no market. And we've had quite a few, like GDI, Rural Funds Group.
Charter Hall. I'm Andrew, by the way.
Is coming now. And Arena, who bought a group of medical centres in Sydney and then listed as part of the Arena Group. And that event has triggered liquidity.
So what John's saying is they've gone from off-market and none of that volatility of the share market, which is what you were hoping for, but they've actually come on market. So it's almost defeated the whole purpose of what you're trying to achieve.
It's brought undone our philosophy, and the philosophy being that, you might have 80% of your investments on the share market and 20% off market. And obviously if these groups that we're in then list, it's destroyed that philosophy, and we have to re-look at our portfolio and say, well, is there another off-market investment? And a couple of weeks ago we talked about the Freight Terminal Trust. That is one of those off-market investments which should give stability and less volatility. But
there's plenty of them out there. And I think if you can say and I know you're saying it destroys the philosophy, which you're right, but one of the benefits is that there seems to be a bit of a valuation uplift. So like we're doing one at the moment. So if you're holding Charter Hall Diversified Industrial Fund number 1, your dollar has now become $1.28.
Correct, yeah.
And so when they list on the share market, one of the short-term positives is you actually get, generally speaking, a pretty good outcome.
Yeah.
But then if you take shares, so again, back to Charter Hall, you can either take shares or cash. If you take shares, you're suddenly opening yourself up to all that volatility,
Correct.
which you didn't have before.
Yeah, and basically what we've looked at now is that the performance of some of those, like Rural Funds Group, that listed at $1, went down to 70 cents. It's now back at $1.60. GDI listed at $1, went down to about 80 cents. Now it's back to $1. So you tend to get a sell-off a little bit because some of them are what you'd call overweight. I mean, in that investment, because it's a small company, and to have $100,000 in a small investment when you've got $20,000 in the National Bank just doesn't seem to make investment sense. So basically a lot of people have sold down, and I think that's what's driven the market
And
down.
you're right, so again, coming back to what you're saying, a lot of people don't want the shares, didn't cash out, day one they list, they think, oh, this is all too hard, and just drive it down. But in this world of 1.5% and 2% interest rates, they're looking at a GDI which is paying 6 or 7%, 8%. So, yeah, it's a really interesting time with these listed property trusts. So I guess, really, we just wanted to bring to people's attention, if you've got unlisted and they're suddenly turning onto the market, it's not our fault.
No.
And what we're trying to do is we're trying to find other things that might suit you, but it's not the end of the world, because sometimes they go up, sometimes they go down when they list, but even when that happens, because people are chasing the yield, they do rebound.
That's the way to go.
Thanks very much.